Greetings, everybody. Welcome to the webinar. Greg Sweeney here. Our topic today is the Great Reset. And by the Great Reset, I mean it is a change in the economic conditions based on, or compared to what we've had over the last 14 years. The last 14 years, we went through a period that was predominantly dominated by what we call free money, or 0% interest rates. The Federal Reserve had a program of zero interest rate policy, or ZIRP, that focused on trying to generate growth and full employment in the economy, and they held interest rates very low for a long period of time, 14 years almost to be exact. And the period of free money, created a lot of distortions. It distorted the stock market, the bond market, it distorted real estate and housing, and it is very unusual in terms of its point of its historical significance. Years ago, one of our competitors, PIMCO, labeled this the new normal. It is highlighted in yellow. In that period, you look at the blue line, which is the Fed fund rate, the short-term interest rates where banks and large institutions can borrow. It had a level that was below the inflation rate. That's the free money that I'm referring to here. If we look at all the period of time prior to that, and I went back to 1980 to consolidate this chart, but basically it would continue forever. This is the only time we've seen an environment where the Fed funds rate had a sustained level below the inflation rate. Every time prior to that, the Fed funds rate was above the inflation rate. Yes, there was a period of time in the wake of the tech stock bubble where the Fed funds rate went below inflation for a little bit of time. But for the most part, it remains above the inflation rate. The yellow box that I referred to on there as a new normal lasted for about 14 years. There's probably a lot of you on this call who started their working career over the last 14 years and think this low interest rate environment is a normal part of the economy, but it's not. So the Great Reset is about how consumers are now going to have to think harder about borrowing money for large ticket items, cars, home improvements, even buying houses, because it's not going to be as inexpensive as it has been over the last 14 years. Our topics today are similar to what they've been in the past. We're going to talk a little bit about the stock market, the bond market, what the Federal Reserve is doing and why they're doing it, and then the impacts on the economy. So let's take a look at the stock market. What's the stock market telling us? If we look at the end of October last year, that was about the low over the last 18 months is what we're seeing on this chart. This is the S&P 500, by the way, and it has since rallied back, not quite half of its valuation since the beginning of 2022. So the stock market's telling us the depth of the market was, at least so far anyway, last October. It's probably telling us that investors have regained confidence in the market and confidence in the earnings outlook for corporations and economic growth moving into the future. Speaking of growth stocks are the ones that are favored in this environment. Value stocks, which did much better in 2022, really kind of faded away, and growth has become the predominant stock theme once again. The other thing it could potentially be telling us is that people are saving money through their 401k plans, and when investors save money through their 401k plans, about 50% of it, maybe sometimes even more, goes into index or passive options. This is the S&P 500 index, the Dow, the NASDAQ, the Barclays Ag on the fixed income side. And investors that use those avenues do not have any gatekeeper that's looking at absolute valuations. The money just goes into the market, and as long as dollar flows are positive, it tends to have a positive effect on the stock market as well. But the question is the market telling us anything else? Are we missing anything? This next screen that we're looking at is the S&P 500 again. Year to date, it's up 7.42%. And we're also looking at the 7 largest holdings in the S&P 500. So the first column is the name of the company. The second column is the weighting of these companies within the S&P 500. The largest two, of course, are Microsoft and Apple. And the third column is the year-to-date return of each one of these organizations. NVIDIA is the champion there, up 85% this year. And the fourth column is the contribution to each of these companies' return to the overall S&P 500 return. Now, it's interesting that there's 500 companies, give or take a couple, because it's not always exactly 500, but give or take a couple, 500 companies in the S&P 500. Collectively, as of April 7th, that benchmark or index was up 7.42%. But of that 7.42%, 6.68% of it, nearly all of it, was in these 7 companies that you see on the screen right now, leaving the other 493 companies out there only generating a return of 0.74%. So one of the things we're missing when we look at the return of the stock market this year is that the returns are very heavily concentrated into the largest companies out there. So the market is what we call very narrowly defined or lacks a significant amount of breadth, B-R-E-A-D-T-H, and because of this concentration in such a small area, small number of stocks. What's the bond market telling us? Bond market is telling us that about the same time that the stock market regained confidence in the overall earnings outlook in the economy back in October of 2022. This is the 10-year Treasury yield. The 10-year Treasury yields were about 4.5% or 4.25% at the time, and they've predominantly trended lower since last October, currently now yielding 3.41%. So the bond market is telling us that they expect inflation to be controlled. They expect, investors expect to be more defensive, okay? So they're not as aggressive. A lower interest rate means that investors are putting money there and are happy with that type of return, even though the inflation is still higher than 3.41%. They're happy with taking that yield because they're more concerned about being defensive in an economy they see that may be unstable. This means that corporate earnings might be declining. This means that the consumer spending might decline. In other words, the bond market is telling us almost nearly the exact opposite of what the stock market is saying. The trick here is only one of them can be correct, okay? We look at the Federal Reserve. You know, what is the Federal Reserve? The Federal Reserve uses monetary policy and that's a fancy name for they control short-term interest rates and they can influence longer-term interest rates with other programs like quantitative easing, which you might have heard about over the last few years because they've been using it pretty heavily. Not only our central bank here being the Federal Reserve, but central banks around the globe have been using that tool as a way to influence longer-term interest rates in addition to their monetary policy, which is controlling short-term interest rates. Now, the first bullet point on there says monetary policy versus fiscal policy, and I don't want to use all these fancy terms for you, so I'm just going to take a minute and tell you what fiscal policy is. So the Federal Reserve uses monetary policies, predominantly interest rates, to influence the economy. And then fiscal policy is where Congress implements programs to support the economy. And in the case of fiscal policy, we've just gone through a very large fiscal policy spending program, which was the stimulus spending in the wake of the pandemic. So Congress's spending, I would say, is one of the biggest catalysts of the inflationary environment today. So fiscal spending put the economy in the shape it was in today in terms of the elevated inflation rates, but monetary policy is being used to try and control that inflation now today. Monetary policy, the intention of monetary policy is to maintain stable growth in the economy and full employment, okay? But sometimes there are unintended consequences to monetary policy, and we're seeing the most recent effect of those unintended consequences was the increase in long-term interest rates that led to a devaluation of holdings on portfolios of, for example, Silicon Valley Bank. Okay, I'm not going to go into the details of that, but that was clearly one of the unintended consequences. And Silicon Valley Bank is not isolated in their holding of U.S. Treasury securities. So other banks also have holdings in U.S. Treasury securities. And even though the U.S. Treasury securities don't have credit risk in terms of default, they have market value risk. And raising interest rates erodes the value of fixed income securities. And the bottom line is, depending upon how those bonds are held on bank balance sheets, there's different forms of accounting for them. Some of you might be wondering about Bell right now, and I'll just tell you right now that Bell is in stable financial condition, so no concerns there. The Federal Reserve is probably close to the end of their interest rate increase program. Maybe one more interest rate increase in May, bringing the Fed funds rate up to 5.25% high end, 5% on the low end. There are some concerns that their tightening credit in the bank lending market might be the equivalent of another 25 to 50 basis points, or 1/4 to 0.5% Fed rate hike. So it looks like the Fed is going to be close to the end of their interest rate increasing program. Now, the challenge when the Fed uses monetary policy in an effort to maintain a stable economic environment and full employment is there's an uncertain lag between the time that the Federal Reserve increases interest rates or decreases interest rates and when it has an impact on the economy. Historically, that's been around 9 months, give or take a little bit. There's some research papers out that say it might be shorter than that. But for sure, it's uncertain, right? So there's a good chance that the economy still has to feel the impact of even the 75 basis point increases that occurred in June and July and September and November last year. There's a suggestion that we haven't even seen the economic impact from those rate increases yet. The Fed continues to target a 2% inflationary environment. And right now, the inflationary environment is about 5%, down from about 9% at its peak. One of our concerns about targeting a 2% inflationary environment in what we're calling the Great Reset that we started out talking about is that 2% inflation is probably going to be hard to achieve now. We're thinking that the inflationary environment is probably going to settle in somewhere around 3%. And since the Federal Reserve has their eye on 2%, our concerns are that the Fed is going to risk keeping interest rates too high for too long and push the U.S. economy into a recessionary environment. Recession is where GDP declines a little bit rather than going up. What do we think is going to lead to this? I started to mention tighter credit conditions from reduced bank lending. We think the consumer is going to be more cautious, which means they're not going to be spending as much. So what could potentially bring about that recessionary environment? I started to mention tighter credit conditions on the previous page. Tighter credit conditions is where banking gets more selective about lending out money, and we expect the consumer to get a little more cautious. I mentioned that the fiscal spending programs in the wake of the pandemic, that would be the stimulus checks, the PPP, the unemployment support, things like that, put a lot of money in consumers' pockets, and it's the spending of that money that really resulted in the inflationary environment, at least from our perspective. It's not so much the supply chain environment that we keep hearing about, but it's what created the supply chain problem, which was excessive spending due to these stimulus packages. But now the consumer has spent that money. Some consumers put it away in savings, but savings has gone back down to normalized levels. Some consumers in a low interest rate environment were using debt to support their spending. We're starting to see that go away as well. So overall, we think the consumer is going to be a little bit more cautious. With a more cautious consumer, we expect there to be some earnings pressure on corporate profitability. So we expect to see earnings to slow down some. Inflation is coming back down, whether it's because of the Federal Reserve's actions or whether it's because the consumer has reduced the volume of their spending, or maybe even a combination of both. But we think it's going to lead to what we're going to call a garden variety recession. I've used the term in the past that I think the recession is going to be more of a headline than it is a problem. I feel that we're going to go into a slowing GDP or gross domestic product environment. But it's going to be a small enough number where it's not going to get much attention beyond headlines. And overall, this new Great Reset that I'm mentioning is expected to bring about a more normal investment return environment. What do I mean by that? Over the last 14 years in that zero interest rate environment, the S&P 500 has gone up 16% on an annualized basis. Long term, the S&P goes up at about 9.5% a year. Housing, for example, goes up at about 4% on average a year. Those of you who have entered the housing market or look at housing know that housing appreciation rates have been many, many times that. Bond market returns on fixed income, normal environment is about 3 to 5%. Interest rates will support that now. They didn't before. So it's a new environment, a new paradigm, if you will. I don't like using that term because really all we're doing is going back to the environment that existed before these zero interest rate environment. So I always like to take the opportunity to remind everybody that market timing is no way to win in terms of a long-term investment portfolio. We looked at the bond market. We saw how volatile that was on an earlier slide. We looked at the stock market and saw how volatile that was on earlier slides. And I know, last October when we went from 4,700 at the beginning of the year to 3,700 at the end of October, how it would have felt really good to sell out and get out of the way of that market decline. But as you see on that chart, as we saw on that chart, that was the exact wrong time to do it, right? That we turn on the news and it's sensationalizing what's occurring in the economy or the environment at the time. But our savings profile is mostly aimed at retirement, right? And so it's long-term in nature, and these things happen all the time. So I'm not trying to tell you to get out of the economy because we think or get out of the markets because we think the economy is slowing down. And I want to make sure I remind you of that. And I thought this slide was a good way to do that. Since 2020, okay, and it's important, or since 2002, right? If you remain fully invested, if you invested $10,000 and remain fully invested, you have about $65,000 at the end of 2022. If you missed the 10 best days in 20 years, the 10 best days, it's more than cut in half to just below 30,000. 20 best days, almost cut in half again. You missed the 30 best days of the last 20 years, and you hardly have more money than you started with. Okay, so this is definitely a long-term marathon. It's not a short-term sprint. Timing the market is a very poor way to win at this. So what are we doing in our own allocations for the stocks and bonds that we manage? From a stock standpoint, we're looking at companies that have solid business models, have good cash flow, and have strong balance sheets to be able to move through a slowing environment. On the fixed income side, we're looking for a duration or an average maturity that is not too short, that exposes the market to reinvestment rate or reinvestment risk. If interest rates tend to go down, then we get stuck with holding lower interest rates for longer periods of time when we reinvest the money. We don't want to be too long, so it's almost like a Goldilocks approach. We don't want to be too long and lock money in if interest rates are going to continue to drift higher. So the Goldilocks approach, we're trying to be just right with our average maturity in the portfolio. We prefer investment grade bonds over high yield bonds. We're trying to build in a good portfolio roll, which means a stable maturity structure where we get a new look at the investment environment along the way. Both of those strategies tend to be working very good right now. So that wraps up our webinar for today. Thank you for joining us. Wishing you all the best. Thank you.